You are 24 years old. Your bank account says 617 ers. Your student loan balance says $38,400. Your credit card says $4,920. So when someone asks your net worth, you do not answer. You do not even know how to calculate it yet. But the system already does. Your landlord knows. Your bank knows. The lender who approved your car payment knows. Every institution around you has already measured your financial life in a way you have not measured it yourself. You think money is about income. You think a better salary will fix this. And maybe for a while, it will feel like it does. But income is not the scoreboard. Net worth is. Today, you are going to see net worth at every level, from negative $38,000 to the kind of wealth that no longer lives inside a normal bank account at all. And by the end, you will understand why the number is not just measuring how much money you have. It is measuring how much of your life still belongs to somebody else. You are at negative $38,000. This is the level most people do not call net worth. They call it normal. Your paycheck arrives on Friday. Rent leaves on Saturday. The credit card minimum is due Monday. The student loan portal sends a reminder on Tuesday. By Wednesday, you are already calculating how long you can delay buying groceries. Nothing about your life feels extreme. That is what makes this level so dangerous. The debt does not arrive as one dramatic event. It arrives as small decisions that felt reasonable at the time. A semester you could not afford. A car repair that had to go on the card. A move to a city where opportunity was more expensive than you expected. Your net worth is negative, but your life still looks functional from the outside. You go to work. You answer emails. You split dinner with friends and pretend you're checking your phone when the bill comes. At this level, money is not a tool, it is weather. It decides your mood before the day begins. It changes how you sleep. It changes how honest you can be with people. You are not thinking about investing yet. You are thinking about making it to the next deposit. The first rule of negative net worth is that income does not feel like progress. It feels like oxygen. Then one month, something changes. You make a budget, not a perfect one, just enough to see the battlefield clearly. You write down every balance: the student loan, the credit card, the car loan, the money in checking, the $42 in savings you forgot existed. For the first time, you see the number: negative $38,000. It looks worse than you expected. But it is also the first honest number you have had in years. You are not free yet. But now you know the shape of the cage. The next level is zero. Nobody throws a party when you hit zero net worth. There is no screenshot that looks impressive. No one congratulates you for having nothing. But zero is not nothing. Zero is the line where your past stops charging interest. You are 29 now. You still rent. Your car is used. Your phone is 3 years old. You have watched people younger than you buy homes, fly business class, and talk about investments you were too embarrassed to Google. But your credit card balance is gone. The student loan is smaller every month. Your emergency fund has $2,100. Your net worth finally crosses from negative to positive by $340. It is not a lot, but psychologically, everything changes. You stop feeling like every dollar is already claimed by someone else. You still have obligations, but you are no longer financially underwater. At negative net worth, the system owns your next paycheck. At zero, you get the first piece of it back. This is where most people make the first dangerous mistake. They confuse relief with freedom. You paid off the card, so you open another one. You finally have breathing room, so you upgrade the apartment. You survived the first climb, so you reward yourself by sliding halfway back down. It feels deserved. And maybe emotionally, it is. But mathematically, this is the test. Zero is not the finish line. Zero is the starting line. You are at $10,000 now. For the first time, your bank account has a comma. You check it more than you admit. The money sits in a high-yield savings account, earning interest every month. Not much, but enough that the account moves even when you do nothing. That movement matters. At this level, you discover a feeling that poor people almost never get to experience: delay. When the car makes a strange sound, you do not panic immediately. When your company announces layoffs, your stomach still drops, but your entire life does not collapse in the first sentence. $10,000 does not make you rich. It makes you less fragile. That is the first real product money buys. Not luxury, not status. Fragility reduction. The emergency fund changes how you behave. You stop accepting every bad deal immediately. You stop saying yes just because the alternative is disaster. You negotiate a little harder. You sleep a little better. The system has not changed. You have. You're at $100,000. This number does something strange to people. It is large enough to feel serious and small enough to feel permanently at risk. You have $62,000 in retirement accounts, $28,000 in brokerage, and $10,000 in cash. You still work for a salary. You still watch your spending. You still feel one medical event, one bad layoff, or one family emergency away from the number being cut in half. But now compounding has entered the room. A 7% return on $10,000 is $700. A 7% return on $100,000 is $7,000. Same percentage, different life. That is the second rule of net worth. The early game rewards effort. The middle game rewards capital. You start to notice how unfair the math becomes once money has mass. Your investments earn while you sleep. Your retirement account grows during meetings. Dividends arrive while you are doing laundry. You are still the main worker in your financial life. But for the first time, you are not the only worker. Money has started working next to you. You are at $500,000. People around you still think you are normal because you mostly look normal. You drive a reliable car. You live in a decent apartment or a modest house. You still compare prices at the grocery store. You still complain about insurance. But under the surface, your life is changing. Your retirement accounts are large enough that a good market year can add more than your first full-time salary. Your brokerage account throws off dividends. Your cash reserve is no longer just an emergency fund. It is opportunity money. This is where the game starts to split. Two people can earn the same salary and live completely different financial lives because one of them has capital and one of them only has income. The person with income must keep showing up. The person with capital has options. At $500,000, you are not free yet, but freedom has become visible from where you stand. You can survive a career change. You can take a calculated risk. You can leave a toxic job without begging the next employer to save you. This is the level where money stops being only protection and starts becoming leverage. You are at $1 million. The word millionaire arrives with less drama than you expected. No orchestra, no private jet, no mansion on a hill. Just a spreadsheet line crossing 7 digits on a Tuesday morning. Part of it is in retirement accounts. Part of it is home equity. Part of it is in index funds. Some of it is cash. None of it feels as spendable as the word millionaire once sounded. That is the trick. Being a millionaire does not mean you can spend $1 million. It means you have built a balance sheet that can begin protecting itself. You think differently now. You notice fees. You notice taxes. You notice asset location. You ask whether the next dollar should go into a brokerage account, a retirement account, a mortgage payment, or a business. The question has changed. At the bottom, you asked, "Can I pay this?" In the middle, you asked, "Can I afford this?" Now you ask, "What does this do to the system I am building?" That shift is the real milestone. The million is not the point. The thinking is, you are above 1 million excluding your primary residence. This is where a legal door can open. In the United States, many individuals can qualify as accredited investors if they have a net worth over $1 million excluding their primary residence, or if they meet certain income tests. The phrase sounds boring. It is not. It means private investments that were invisible to you before can now legally be offered to you. Private credit, venture funds, private real estate deals, startup rounds, hedge funds, offerings with documents so dense most people never read them properly. The system does not suddenly become generous. It becomes more complex. At this level, access increases, but so does the quality of the traps. Bad investments do not disappear because you have more money. They become better dressed. The salesperson has a nicer office. The PDF has better design. The minimum investment is $100,000 instead of $1,000. The risk is still there, sometimes more of it. This is the third rule of net worth. When your money grows, the world does not only offer you better opportunities, it offers you more expensive mistakes. You are at $10 million. Now, the financial system starts speaking to you differently. Banks return calls faster. Wealth managers use words like preservation, structure, estate, and legacy. Tax planning is no longer something you do in April. It is something designed years ahead of time. Your money is no longer held in one place. It is distributed through brokerage accounts, retirement accounts, real estate, private investments, insurance structures, trusts, and entities with names most of your friends would find unnecessarily complicated. But the complexity has a purpose. At 10 million, the question is no longer, how do I become rich? The question is, how do I prevent one mistake, one lawsuit, one tax event, or one family conflict from destroying what took decades to build? Wealth at this level becomes architecture, not because rich people are smarter, because the consequences of poor structure are larger. You are at 100 million at this level, net worth stops looking like personal finance. It becomes institutional. There may be a family office. There may be advisors who never speak to each other directly unless someone coordinates them. Lawyers, tax specialists, investment managers, trustees, insurance experts, bankers. Your calendar has fewer conversations about budgets and more conversations about exposure. Market exposure, political exposure, currency exposure, reputation exposure, succession exposure. The money no longer only affects your life, it affects other people before they ever meet you. A business gets funded, a building gets bought, a company gets restructured, a foundation writes checks, a family member receives money they did not earn and now has to become the kind of person who can survive receiving it. That is the part nobody explains when they talk about wealth. At the bottom, money can trap you. At the top, money can distort you. Different problem, same machine. You are no longer trying to get enough. You are trying to understand what enough even means after the number stopped answering the question. And somewhere tonight, a 24-year-old opens a banking app and sees 617. He does not calculate his net worth. Not yet. He thinks a better paycheck will fix everything. He thinks the goal is to make more money. He thinks the number in his bank account is the number that matters. It is not. The number that matters is quieter. Assets minus liabilities. What you own minus what you owe. The part of your life that belongs to you minus the part that still belongs to somebody else. At the bottom, net worth measures stress. In the middle, it measures options. At the top, it measures access. And the moment you begin measuring it, the machine begins to look different. Not easier. Different. That is where the